What's up, everybody? Welcome back to the Next Win podcast with your host, Aunt Ma, co-host Justin Vaseur, and special guest, our lender friend, William Wynn.
Hi.
We have a very special episode today because while we have a lender here, I want to ask the questions that everybody has been thinking about for the last year. And that is, when should you refinance?
Ooh.
Right? Everyone's been buying a home in the last year when rates have been up. And they're thinking, they're going to refi in about a year or two.
Yep.
Right? That's everybody's goal who's a new homeowner. So I guess first off, William, what is refinance? What does that mean?
So refinance is basically you're just refinancing your original loan for either another 30 years or another 20 to 15 years, depending on your situation, to lower your rate, to eventually save more money, and to lower your monthly payment, basically.
Okay. So it's getting a new loan
without the hassle of buying the house, you just refinancing that loan to get a better rate, basically.
The misconception that a lot of people tell me that don't understand the real estate world, they say, I never want to refinance. And I'm like, why? And they say it's because they think that when you refi, you're refining the whole amount over again.
No, yeah, you're just refining the amount that you owe.
Right.
Currently.
So that's saying that if you have a $400,000 loan and after 2 years, you paid off like 30 grand.
Yep.
And your loan is now 370. Now when you refi, you're refinancing that 370,000.
Yep.
Not 400.
Yeah. And on top of that, it also helps with if you only put 3% down, you're paying that private mortgage insurance, and for FHA, you're paying that FHA mortgage insurance. So when you refinance, that falls off, especially if you have 20% in equity. So
how do you find out if you have 20% in equity so it can fall off?
You would have to check, your home value of your home versus the loan amount you have.
So by checking the home value is like, if you did the refi and you got it appraised, that's
When you got appraised, yeah. But you get an idea when you look like a Zillow and stuff. You kind of see how much the increase is. It's not guaranteed. It's because you have to actually have an appraisal to actually have the real number, because sometimes it's off. But usually, you talk to one like me and my lender, and yourself too. We kind of know where the house price is at and go, it's a good time to refinance, to drop that. Usually, mortgage insurance can be $100 to like $500 a month additional. Yeah. So now you're right off the bat, right there, you're already saving like over $100, right? And then on top of that, when you're refinancing because the rate's lower, you're still saving another couple $100. So it's big savings for refinancing.
Do you know what he's talking about, Justin?
Yeah, I know what he's talking about.
Nice.
Yeah.
I like that. All right. So
I've done my research. No, I'm just kidding. I do have a question. If the value of your home goes down, can you refinance?
No.
You cannot. Why not?
Because you be owing, because now the house is worth less than the loan amount, so it'll be hard for us to refinance. That was the problem.
Okay.
Like in 2008, people can the rates shot up.
So yeah,
and then people can't refinance because the house is not worth the loan amount. So we're not gonna lend you money when the house is not worth that much.
So that's a two-part question, because he's saying no, you can't if the value of the home is less than what you owe.
Yeah.
Right.
But if the price dropped, but it's still more than what you owe, then you can.
Yeah, of course. Yeah, as long as you have equity, right?
As long as you have equity.
So what I'm saying is let's say in 2021 when the home prices went really high, and these people were already homeowners, yes, I'm like $200K richer, and then today it went down $100K, and for some reason they didn't refinance at that time, they weren't available, so now they want to refi for some reason,
It'll still be okay.
Then they can, because even though it dropped $100K,
you're still above. As long as the value of the home is not less than the loan amount you owe.
You think that's going to happen when the rates drop? The value of the homes are going to be low?
No. I think they're going to go up.
Yeah. The only time it happened was back in 2008 when it was the crash.
Yeah.
That's why there was a crash, because people couldn't refinance. Their house was basically, it's called underwater. So basically it's I owe $800,000. My house is only worth $600,000. We're not going to refinance that. You're stuck.
The difference between then and now is that what was your question that you asked again? You said, is it going to...
Can you refinance if the house value is less?
No, but I think I asked. No. You think that's gonna happen when the rates go down?
Oh, is the house value gonna go down? Oh, yeah. That's what you're saying.
Because like right now the rates are really high, and then that causes the prices of the homes to go down, right?
Correct. Mm-hmm. And then once the rates go down, the value is gonna go up because people are gonna start buying, and then they're gonna have a bidding war.
So I think when rates go down, it shouldn't affect house prices. It kind of
separate. They're two different things. Yeah. And the difference with 2008 is that people weren't able to buy homes,
and people. So that's why. And there's a lot of foreclosures, and that's why house prices dropped.
Yeah, that's why prices dropped, because when the banks started shutting down, and then more regulations were needed to get approved for loans, people couldn't get approved anymore, and that's why you can't buy a home. Then the prices go down. Yeah. But right now, if the rates drop, people are buying homes, and it's going to make the prices go up. Because people are like, oh my gosh, it's now back to 5%. I'm going to put $20K over asking and get it now. The other guy goes, well, I'm going to put $40K over asking and get in. And then there's
because when the housing crash, the rates didn't drop that fast. The lowest rates was during the pandemic. So it wasn't like that low before. So
I see. Okay.
Kind of two separate things.
Yeah.
So I have a question for you. When should everybody refinance? That's the question that everybody is wondering right now.
You can refinance anytime. Usually the lenders will say, you have to wait 6 months after your loan closes, then you can refinance. But you can refinance anytime, basically, as long as you're saving. I would recommend saving at least half a point.
How much is half a point?
So like, let's say your rate 7%, half percent.
I'm just kidding. All right, so in another episode we're talking about what does points mean, because I think lenders have their own vocabulary, and me and Justin are like, what does that mean?
Yeah, sorry. So basically it's 7% and the rate's down to 6.5. It's kind of worth it, because the half percent sometimes that makes a big difference. So it depends on the person. Some people are like, even if they save $40 a month, they're like, do it.
I have a friend who's an appraiser, and he refinances anytime he saves $20 to $40.
Yeah, they'll do it.
I'm like, what?
Crazy. Isn't there a cost to that?
Yes, there's a cost of refinancing.
The cost is usually about
$3,000.
Yeah, $3,000 on average.
But the thing is, people don't mind, because we can roll that into the loan. So it just adds to your loan amount. So technically, you're not paying anything out of pocket.
So here's another thing. If you buy a home through me and William, he will give you a free refinance within 5 years. Now, with you saying that it gets rolled into the loan, is that what happens? Is that why it's technically quote unquote free?
No, we don't charge anything. Yeah.
So right off the bat, guys, get a home from this guy and refinance for free in the next few years. For free $3,000.
Are you able to throw other debts into your refinance?
No, the refinance is only for your property. Once you start, and it's called cash out refi. So basically, if you want to use your equity to pay off like credit card debt, because a lot of people are doing that back when the rates were low. It's called a cash out refi. The rates are a little higher, but basically you can refinance over at least, I think, like 80%. As long as you don't meet over the loan to value, basically maximum. Some people pull out $100,000, $200,000 cash. Now you're, instead of you owe $400,000, you owe $600,000 in your loan. We'll give you $200,000 cash, basically, and you can use that to do whatever. When the rates were low, people were doing that to pay off credit card debt, because now you're only paying 4%, 5% instead of like 18%.
Yeah.
Right?
Can you explain the actual difference between a refinance and a cash out refinance?
So a refinance is just refining your home loan. That's it. No cash out. Like, we're just refinancing to drop the rate, drop your payment every month so that you save money. Cash out refi is people taking advantage of their property. That's why people buy houses, taking advantage of their asset, right? The equity they have. So basically, when you bought it was worth $500,000, your loan's $400,000, and now the house is worth $800,000. So basically, you have about 80%. Some goes to 90% loan to value. So you can pull about that $200,000 extra out to use for yourself. But
and is that a second loan?
No, it's so when it's a cash out refi, it's one loan. So basically, we put it into your loan, your own mortgage. So instead of only $400,000, now you own $600,000.
I see.
So it's not bad because the rates, cash out refi rates aren't better than home equity line of credit when we get into later, and other lending options because the rate's usually lower.
Oh, so a cash out refi and a refinance is not the same rate.
Not the same rate.
Oh, it's higher.
It's a little higher because we're giving you money back. It's a little bit higher, but it's still lower than a home equity line of credits, lower than personal loans, lower than credit cards.
I feel like most people would do a HELOC more than a cash out refi.
It depends.
Because now we're talking about a HELOC. People do like $200K off a high percent.
Yeah.
Compared to a cash out refi where it's a high amount, like 600,000 off a lower percent. Right. And we learned in our previous episodes when we talked about, is it better to buy a home when the home costs a lot with a low interest rate or to buy it with a price drop with a high interest rate? And we realized it's actually the one with the, I believe it's the one with the higher interest rate. No, the lower interest rate.
Lower interest rate. But it all depends on what you need them for in your scenario and what your financial goals are. So if you're planning to keep the house for a long time, then it might be worth it because in the long run you might save more money. But it all depends. Some people do the HELOCs because they're doing quick turnaround investments.
I see.
Yeah.
Okay. So So from what I said, I confused myself. But it's actually the cash out refi is better for you. It'll be cheaper.
It'll be cheaper depending on the goal. Depending on the goal.
But the HELOC, you can pay off any time. Yeah. That's the difference.
Yeah, and it's interest only payment.
Yeah.
So we'll go into HELOC in a little bit, and then we kind of like basically HELOC payments lower.
Yeah.
The payments are lower for HELOC because you're paying interest only.
So it's like,
so it depends on what you need it for.
If I let's say took out that money to buy a restaurant, and then my restaurant became so successful that I want to pay back that $200K on the HELOC, I can do that right away, and then my loan is closed.
Yep. Right? Or it stays open. The HELOC stays open, but you don't
I don't owe anything anymore, right? And then for the cash out refi, if I made that $200K, I can't pay it because it's actually $600K that I borrowed.
Yeah. Right? Basically. You can still put it back and lower it.
Oh, you can? So if I have a cash out refi, I can just always pay like
you can always pay additional principal. You can always pay additional principal to lower your principal, and then if you have, let's say you put $200,000 into your principal, we can do a recast. So recast is not like a refi, but we can just recalculate the amounts. The rate stays the same. Like we just recalculate the amount and then lower your payment that way.
So you have to do that in order to lower the payment, right? Because if you don't, and you put in that lump sum of like $200K
your balance basically just shaves off years of how much you say in 30 years. Now you just shaved off maybe 10 years. Yeah.
No, but you want to actually lower the monthly.
Yeah, you want to lower your monthly pay. So you make the payment. You go, hey, I want to do a recast. You call the lender and go, I want to do a recast because I paid $200,000 in principal, and now they'll recast it. Can
I do the same thing when I buy a car?
So I know car you can refinance. Car loans.
Oh yeah, I've done that before. Yeah. I bought a Tesla Model X, like a 2016, back in 2020, and I bought it at a used car dealership, just some mom and pop shop, and his rates were so high. But in order for me to take it off the lot, I had to go with his loan, right? And then the next day, I called Bank of America to refi.
Yep.
So I never made a payment to that guy. I instantly made it to Bank of America, which saved me like 3%, on an interest rate.
A lot of people do that. A lot of people buy the car, and then the payment's like $700. And maybe like 2-3 years down, and they paid off a good amount. They go, I want to refinance, and the refinance the rate and the loan amount because it's lower, and then the car payment now is like $500 instead of $700. So
I feel like with refinancing cars though, they throw the fees into that amount because I never had to pay extra to refinance a car.
Oh, I think it's because you're paying interest already. Yeah, I think it's just interest. I don't think there's no fee. Yeah, because
it's a big bank.
Yeah. It's still just interest. Business. Yeah, just want your business.
I see. So yeah, I was thinking like, after paying off my car for 2 years and I still have more payments, like, can I just drop $10K down to them? Does it do anything? No, like you said, it just shaves off years.
It just shaves off years, I think. And then I think with cars, you have to refinance. There's no recasting. For mortgages, we can, but not honestly for cars. When
you refinance a car also, like, so when you refinance a home, if I wanted to give you $100K, you can lower my payments that way too, right?
Yeah.
Okay, but you can't do that with a car.
No.
I can't tell the bank, hey, I want to give you 10 grand to pay.
I think you can give the bank 10 grand, and you still have to refinance. If that way you can, because here's 10 grand. I want to refinance, but put this 10 grand to lower my loan, and you can do that still.
Oh, I see.
So it'll lower the payment, but for like the recasting, like how you give me money without refinancing, we can just recalculate the balance without any.
I have a random question. If you refinance before like purchasing a home, does that hurt you?
Refinance what though?
Before your car or something? No. Oh, okay.
No, I do that all the time.
Yeah. Yeah. It's usually with the same bank. They don't pull credit usually.
Oh, really?
Yeah. Oh. And I always recommend, my personal opinion, credit unions for car loans.
I have a credit union, and the easiest for me and the cheapest was always Bank of America.
Oh, wow. Okay. Yeah, so depending. Yeah. I know we have, because my wife used to be a teacher, so we have a Schools First. And their rates are low, and it's so easy. Like they'll pre-approve you, and like you're pre-approved for $50,000. That's sweet. And you just go, I want to use that pre-approval. I go, here's a blank check, or like a $50,000. No, actually, you can go out there and look for a car $50,000. Yeah. Just how much the value is. They don't check my income and everything. You're pre-approved.
Oh my gosh!
And then I found a car. And then I just go to the bank. They give me a check. And give it to
that sounds so easy.
It's very easy. I was surprised coming because I used to work in a bank. Yeah. I'm like, are you sure? Like, they just literally gave me a check, walked to the dealership, and then I picked up the car.
I think that's tight. That credit union, because when I tried with mine is like a police force credit union, which should be helping everybody, right? You're talking about like LAPD or whatever it is, right? And you have to be family to have that, right? So when I did mine, it was so difficult that I just stopped. And also the rate was pretty much the same as Bank of America.
Yeah, the teachers one, they take care of the teachers. You don't have to be a teacher. As long as you have a family member that's a teacher or you work in the district. That's how I got it. Well, I got it because my wife, she used to be a teacher. And like that experience was like, wow. Like I was like, no credit union like that. But then once I got that, I've been buying my cars through credit union. It's so easy. Yeah. Like I have to worry about bringing my taxes, proving my income. But then this one's like, okay, you're pre-approved. Here's a check. Go buy your car.
Junbi matcha serves high-quality matcha straight from the farms in Japan. The matcha leaves are hand-picked by farmers to create the purest form of matcha straight to your cup. They currently have 5 locations around the U.S., 2 of them being in the L.A. area, which is Rowland Heights and Westwood, 1 in Princeton, New Jersey, 1 in Dallas, Texas, and their newest location on the Waikiki Beach in Honolulu, Hawaii. If you don't have a Junbi near you, you can always purchase their matcha tins or pre-made packs. The most popular are the blueberry matcha and the vanilla matcha. You can just mix it with water, and you'll have the same great tasting Junbi teas at the comfort of your own home. What is an arm, guys? No, it's not the arm with the muscles that Justin is displaying right now. Huge. We ain't talking about guns. And whose guns are bigger? Let's see. I don't really work out that much.
I don't work out either. Justin. That's hot.
Justin. That's hot, bro. Dang. All right. So, William, or actually, Justin, what do you think an arm is?
Honestly, I don't know. I can't even. Yeah, I have no idea.
What do you even think it pertains to?
I mean, obviously homes, some type of maybe loan or...
It's an acronym for adjustable rate mortgage.
And what does that mean?
That your mortgage rate is not locked for 30 years. So there's 2 types of loans, traditional, conventional mortgages. There's a fixed 30 years, or actually a fixed rate, usually 30 years,
or 15
20 years, or 15. And it's 10-year too. Yeah, but it all depends. But the lower your years, the higher the payment. But if you can afford it, you'll save money in the long run and interest. ARMS, adjustable rate mortgage, is for people that aren't planning to stay in their homes for 30 years. So basically, there's 3, 5, and 7-year and 10-year ARMS. What that means is basically the rate's usually lower for the first either 3 years, whatever you pick, 5 years or 7 years or 10 years. So let's say 5 years for the big and simple. So your rate is fixed for 5 years. After that, every year your rate can adjust up.
By how much?
But there's usually a maximum cap annually. How much your rate? So you can't get screwed over if the rates jump like 10%. You're not going to get screwed. There's some protection there.
Oh, it adjusts to what the market is.
Yeah, it adjusts what the market is, but there's also a cap. So basically, some companies will have a 2% maximum per year. So let's say the rates jump 4% that year. they can only raise it up 2% on your loan.
But
every year they can raise it up every year.
What if the rates go down in the market?
So you have a protection for going up. Of course, there's going to be a protection from dropping. So basically, usually it's whatever your rate, your original rate is, the low rate from the beginning, you can't go below that. So the bank's here to make money. They're not going to. Yeah.
This sounds more like when you're a business owner and you're a tenant, and your landlord makes you pay 3% increases in the rent.
It's basically like that
for your business. That's what it sounds like.
It's basically like that. So basically, that's good. That's a good example. So basically, I say you're renting for me. I go, I'll give you your rent fixed for 5 years, but after that, I can raise it every 2% every year.
Yeah.
Yeah, but I promise you, the maximum I can raise it. The maximum of your whole time living here, the maximum is 10%.
So I have a question. Right now, because the rates are so high, we're like at 7.5% in today's rates, right? Very close to 8% soon. Should more people be looking into ARMs than 30-year fixes right now?
It depends on your situation and how much difference. So
what is an ARM right now today?
I have to look. I haven't checked today, but I think they're only a little bit off by the fixed rate. Because sometimes I think when the rates were low, it was a big difference.
Yeah.
Right now, they're pretty kind of close.
So you think if today's rate is 7.5 and the ARM is 7? Oh, 6?
Maybe 6.
Oh, so it's like 1.5% lower? Yeah. That's pretty cool.
But before, I used to be like 2-3%.
So
it would be like super worth it.
Okay. So if I'm that guy that's always buying a new home every 4 to 5 years, sometimes 2 years, shouldn't I be doing ARMs then?
It depends. Yeah, that's why it depends on your situation. So
what?
Yeah, it depends. We have to look at the numbers, of course, and then if it's rate, it's also a gamble because you're gambling that if you're gonna sell it, you're fine. But some people are the other option is to do it and then refinance. Like same thing as our temporary, instead of a temporary buy down, this is kind of like a semi-permanent buy down.
Yeah.
For like 5 years, but then after that, your rate increases.
So I know you're using the 5 years ARM as an average of what people do.
Yep.
Which year ARM gets you the lowest rate?
I think about 5. That's why I chose 5. Usually 5 or 7. The rate all depends on how much risk the bank's taking.
Yeah.
Yeah. Or what the bank wants.
Okay. So right now, if I did an ARM today, let's just say it could be 6% for 5 years.
Yep.
And then after that, we can refi.
You can refi anytime.
Anytime.
You can put it back to a 30-year rate if you want to.
So why aren't we helping our buyers with that right now?
Because sometimes I think the payments almost the rate. I think right now the rates were pretty similar, and sometimes the payments higher because the term's shorter.
Is the cost to do that higher too?
No, this should be the same.
I see. Because I'm just like, why didn't I do that every house I bought?
Yeah, that sounds pretty interesting actually.
Well, here's the catch: is
payments higher. I think usually it all depends.
What were the year terms?
Yeah, it depends. There's 3, 5, 7, and 10.
So it is like way higher than the monthly payment. Because if you're going from a 30,
it's still a 30-year. It's still a 30-year loan.
Oh, so it's a 30-year loan.
What I mean by that's how long the rates are fixed.
I see.
Yeah, okay. It's fixed for 3, 5, 7, or 10.
Yeah, but then you don't refinance. Let's say rates shoot up, and let's say rates shoot up for the next. Let's say you do the 5 year, and 5 years rates super high, then you kind of asked out because they can increase the rate on you.
Mm-hmm. So is this something for investors? Like if they're doing a flip home, so they buy a home that they got to completely gut out, remodel.
It could be investors. It could be people that are like I had a cousin of mine that didn't want to do ARMs only because he's going to live there less than 5 years. So he rather take the lower, save money and interest, right? I think the payment's a little higher, but to save money and interest, he's saving money on interest. And because he's going to sell in 5 years, so he'd rather save money and interest, basically.
Man, there's so much to learn about real estate. It's insane.
Yeah, ARMs get confusing, so that's why I
mean, it's not confusing. There's just so many things to know.
Yeah, because there's so many different options, and the way how they calculate is different. And then we have the temporary buy downs, which we've been doing a lot. So I've been trying to touch myself back on ARMs because not a lot of people do ARMs.
So here's another thing that I know because I've been in escrow since I was like 18 years old, and which is like over 20 years ago. And, when I was doing escrow and I look at the paperwork, a lot of, all we do are refinance. That's all the time. And then I see some with arms, and then I see the word balloon in it. I'm like, what does balloon mean?
Yeah. So,
that sounds scary. So dangerous.
What's up with these words?
Yeah, what do you think balloon is?
Balloon. Oh, I don't even know. You said it sounds scary.
It sounded scary because not many people. It was a rare case that I saw. So when I see that, I'm like, why does this person have a balloon? What is that?
It's scary. So basically, a balloon, depending, there's loans out there, and say a balloon payment. So basically, let's say they do the 10-year, right? That's not a 30-year loan. So basically, they'll give you a rate for 10 years, a low rate, but after the 10 years, the full payment is due.
The full payment, so if you have a $400,000 loan,
you owe whatever's left over.
$350.
Yeah, you have to pay the $350.
And what happens if you don't?
You lose your house, or you refinance. You try to get a loan somewhere else.
Why would anyone want to do that?
It's for people that investors. A lot of investors are like flipping homes, or people that can't. I've seen a lot of those balloon payments where people can't get traditional financing.
What is the benefit to get the balloon though? Is the payments lower? Is the rates lower?
I think the rates are lower.
Okay.
I think I don't deal with too much with balloons, so I would have to double check.
So
I want to deal with balloon payments on hard money loans, which is a separate thing by itself. That is not a traditional loan at all, and something I don't do, but I do have a friend that does it, and I've helped them with a client.
Yeah.
Because a lot of hard money loans are for clients that cannot qualify through traditional lending.
It's just like creative financing.
It's creative financing, but they're very short term.
Yeah.
Their interest is higher. Actually, some of the balloon payment ones, like hard money loan, interest is way higher, but people are willing to pay it because they need to get stuff done.
Who is a hard money lender? Is it a person or a bank?
They're usually private. So basically, hard money, it's a wholly different thing. So hard money loans are usually what they do is companies, like they're kind of similar mortgage companies. They say you want a hard money loan for like $200,000, right? There's usually smaller things like to flip houses and stuff. So basically, it's for the people that want to flip houses and stuff. So I want to borrow $200,000. You tell me the project. I'm the lender. Tell me the project. I put it up on this form of investors, and these single investors, I'll put my money in it, and they get. Usually it's like 12, like high percent.
Is it like
it's like crowdfunding? Almost.
But this person that's collecting all these investors is an actual company?
It's an actual company. It's like I'm a lender.
So like I can create a hard lender LLC or
kind of like that. I don't know how you get into it. I think you have to get licensed and stuff. But
license. I see. I thought it was like, okay, now with this, I can go to Facebook and be like, who wants to put in 10 grand?
They have their own like whole. You can do this a whole episode about this, but. And we have to look into it. But I know I have a friend that does it, and then the reason I know because I had to help a client. But it's a whole thing, dude. They have like a whole website for these private investors. It's like we're balling. I'm like, let's invest in some loans. It's like because these loans are like 13%, and it's only like 12 months usually, right? So like, I'll lend you $200,000. You have to pay me back in 12 months. Every month you have to pay me 12% interest. But after the 12 months, you owe me the whole balloon payment. Basically, you owe me the whole $200,000. So you better either refinance or find it somewhere. So
people can refinance before the balloon happens.
Yeah. So that's how we did it. So let's say this in this particular scenario, the business owner wrote off a whole bunch of taxes the year before, so we couldn't do it. But the year that they need to get the house redone to flip, so they did a hard money loan, and then they're going to pay taxes that year to show their income increase. So then before the hard money loans due, we can refinance because they'll submit their taxes and I can use the new taxes.
I see.
And then now they qualify for traditional. So it's like sophisticated, like special scenarios like that.
Yeah, I mean, like it just has to be a well planned
it has to be planned. But a lot of wealthy people do it because it's real, like it's fast money.
Yeah.
It's like 7 days usually.
Yeah, I mean, like even we planned for me getting this home because I have so many different businesses and we had to plan out the taxes to get the home that I'm in now. So you guys always have to think about the future. So when you guys reach out to us and you can't get a home, I still want to talk to you and figure out the plan and the path to put you on. So in a year or two, you are ready.
Yeah.
Rather than you guys telling me, hey, you know what? I'm not ready right now.
See you later.
I'll call you in like 2 years. I'm like, well, if you do that and if you don't have your stuff in order, then you guys have to like
redo it again.
Redo it for another 2 years to be on the right, have the right structures in place.
Everything you do, anything you do financially, like to win, is you need a plan. Like that's what I did when I was financial advising. Is like we can't do it today, but let's plan out how we're gonna do this in a year.
Yeah, what you need to do. Do you need to pay off some debt?
Save.
Do you
how much money you need to save?
Yep. What you need to do for taxes? How much more money do you need to make or write off or whatever it is? So,
is the 30-year fixed like the safest option?
Yeah, usually. If you want to put it, forget about it, not worry about it, then 30 years fixed. But if you want to be more savvy about it, then you can look at all these other options. But when we talk, when let's say you come and talk to me, I'll give you all the options, and then I'll give you all the options, scenarios, and you see what best fits for you. So
I think people who have a lot of money or they're okay in their life, they do 15 years. Fixed,
yeah.
You know, or if they're veteran.
Yeah,
right? Because veterans are 0% or something like that.
Yeah, but the payments, if you can afford to pay, because the payments are higher.
So
it's like
the less years, does the rate change at all or not really?
Yeah, sometimes it changes lower. It all depends on when it is.
You're asking for a 15-year fix if it changes?
Yeah, like
it does not.
It's
a 15-year fix.
No,
I know, but what I'm saying is like
30-year.
Yeah, like is the 30-year? Can you get like a lower rate with the 15-year?
Sometimes,
yes.
Sometimes, okay. Sometimes it's lower because it's less. It's we were paying off quicker.
So,
but sometimes it's almost the same.
Let's say right now the rates are 7.5 for a 30-year fix. A 15-year could be 7.
Yeah, like a little bit different.
I see.
Or 7.25.
But you'll save. At the long run, it's for people that want to save. They're thinking far ahead.
Yeah.
Because now you're saving like over 15 years of interest.
Yeah.
So the great thing is like if the home you're buying is like small, I would say 500K and under. Okay. If the home was small, 500K and under, and if the rates were better at like 3 to 4% right now, then doing a 15-year fix would be great because your payments would be like $1,500 a month. Okay. And then you could pay that off in like 15 years. So compared to a 30-year fix, it would be like $800.
Lower monthly, but long run you pay a lot more interest.
Sorry, and I'm also talking about like 20, 30% down, something like that.
Yeah.
So
all depends on your situation. Some people don't want to pay interest. Some people want the lower payment every month. So they'll go, I want the longest rate. Like buying a car too, right?
Yeah.
Mm-hmm.
Like I wanted 72 months because I want to buy a freaking $100,000 car. I want to keep the payment as low. Give me the max months you can do. Like I think they have like 80 month now terms.
Can you believe that 10 years ago, at the highest monthly payments, which is getting your 15-year fixes, those are usually highest monthly payments, was only like $1,500 a month.
Man.
And right now, people are like $4,000, $5,000 a month. On a 30-year fix, like this is crazy.
So like 15-year be like 6,000.
10 years ago, I was like, wow, $1,500. Like I'll take the 30-year $800 a month. Like that's too much.
I mean, car payments now, dude. Remember, like normal average, like what before back in the day it was like 300, dude, 400.
That's because now car prices are like $60K a car.
Yeah, dude, that was like $800 a month.
It's like a Corolla. You're paying like
40K.
Yeah, 40 to 50K for some dumb shit. Yeah.
Well, because now they got like leather seats, they got like better engines, they got all these kind of things, man. They got rims, Type S's, Corolla Type S, right?
Yeah, the little ones. Those are cool, dude.
They are, but when you gas it, doesn't go anywhere.
Those sporty ones faster, right? Isn't it? Well, I can't fit in those cars anyways.
This is the most popular matcha tin. It gives you the energy you need to prepare for your day without the crash, mainly because of its high quality. Make your own matcha at home with their daily ceremonial grade matcha. All you have to do is scoop, whisk, and enjoy. So this matcha tin is 100% pure shade grown, finely milled matcha. It's sourced from a 100-year-old farm in Japan. It pairs deliciously with other ingredients, and it fuels you to prepare daringly for your adventures ahead. The Fed said they're going to raise the rates 2 more times.
Damn.
That sucks.
I quit, dude. I ain't buying
bad,
a house
right?
no more.
Well, maybe maybe aliens will show up and then it'll crash the market.
Oh yeah,
I like that one.
Yeah, that's gonna be our next pandemic.
Aliens, yeah.
See, and then you guys are all hating about Will Smith. He's the one that's gonna save our lives. All right, if the aliens come, he's gonna slap the shit out of all the aliens.
What was the name of the actor of Independence Day? The president.
The president.
He's the best president.
Is it? I was gonna say Jeff Goodman, but no, I don't remember.
I don't remember his name, but he's the best president. That's the best.
He was the coolest guy in the world, man.
Yeah, that was the best speech ever.
Yeah, he was dope. So we are talking about right now. Interest rates are like in the 7.5%. If they're raising it, we're talking about we'll go to 7.75 and then 8%, maybe 9%. If that happens in Q4 of this year, are people buying homes?
No,
not really, right? Some, but not really. Are people, because that rate went up, credit cards go up, everything goes up. So are people buying cars?
I don't think so.
Maybe.
Yeah, I mean, there's always going to be there's always going to be people buying stuff, but
it's not as when everybody.
When you talk about the majority, I think most of people are going to be like
they're going to wait it out.
Yeah, they're going to wait it out.
Because right now Christina wants to buy a new car, my wife, and I'm
really?
like, okay, well the rates are about to go up, so do we want to hold off right now?
Yeah. So I want to clarify that when the Feds say they're raising rates, they're raising the prime rate. So when they raise the prime rate, anything that is a credit card loan, all that car loan, credit cards are affected because those rates are prime plus the margin the bank adds onto it.
What is the actual definition of a prime rate?
Prime rate is what the rate is. That's the standard rate the government has set of interest rate they'll charge to lend money. Right, so that's why I don't remember the exact rate right now, but back in the day it was like 3.75, but now it's like I think 5-6%. Right, so that's the minimum rate that banks would charge, and then banks would add their profit on it. So basically that's why credit cards are like 18% right now. Right, when it goes to mortgage rate, it doesn't affect mortgage rates directly. However, recently it's been raising it still. So,
do you know what else raises when the prime rate goes up?
What else?
Tips at restaurants. Yeah,
tacos. Everything goes
tacos al gordo.
Yeah,
like everything is raising.
Because what's up with these tips, bro?
Yeah, they're getting crazy, man.
I don't understand tipping culture right now.
Right now, when you get this electronic.
Yeah, like when you buy boba or like coffee, it's like here they turn it around, make it all awkward. Here you go.
Yeah,
you can choose the option. Like you just took my order. Like,
and I'm used to 12%, 15% if it's really good service.
Yeah.
But now when I'm seeing these electronic things come to me,
it starts at 18,
it starts at 18, 20, 22.
Yeah.
I'm like 22.
Yeah.
Like I'm literally buying another meal for you.
Yeah.
Yeah.
Like I could have. Right now, I'm buying a meal for my wife, for me, and then we share with the kids.
Yeah.
Like I could have bought a meal for my kids, but I gotta tip you that meal. Oh my God. And you're gonna give me shitty service?
Yeah. That's the thing. It's like you're not doing anything.
Yeah. Well,
you know what I mean?
It depends where you are. Like especially when you take orders like those global shops. Like, bro, you just taking the order. Like you do your job, bro. Like you're not serving.
Yeah.
Because I remember like getting tips for like going out of the way to do stuff or whatever. But now it's just
everything's like,
I used to be a server for a long time, busboy, all these things. And when I was a server, like, you are just taking the order and grabbing plates.
Yeah.
That's it. That's all you're doing. And then saying you want some water, right? And then for the most part, that's all you do. But I think the reason why there's tips is because it's for the people who have to keep servicing and providing customer service to the tables that are a little bit more difficult and needy.
I don't mind tipping those servers. Like when I have good service, like I'll tip them like on the thing, but I'll tip them on the side too. Like
that's
like,
what
like
I
cash.
got all the time.
Like I'll get cash or like give me your Venmo and I'll Venmo you because they sometimes they have to share that tip.
Yeah.
I'll chip them like directly to Venmo.
I don't know how many times as a busboy people will pull me to the side and be like, "Here's $10 for you, dude. I see you hustling. You're giving me so much water. You're sweating." And I'm like this 18-year-old kid and like I'm doing more than the server. And I'm just like, "Here you go, $10. So I remember as a busboy, dude, I was making like $200 a night in a place that I should be making like 60 to 80 if I was a good busboy.
Yeah.
You know?
Yeah, but like for those guys that just shitty service and then like
Yeah, the ones where like
it's basically an extra tax right now.
Yeah, it is extra tax. Basically.
Yeah, it's crazy, man. So the reason why we're talking about all this stuff, guys, is because with everything raising up and people are going to slow down on purchasing things, it's going to cause people to start losing jobs because if you're not buying anything, people are not needed to help you.
There's no income for those businesses.
If you're not buying a car, you don't need 100 salesmen in the lobby.
Yeah.
Okay? They're going to fire everybody.
Same thing with loans. There's a lot of not loan officers when the market's been bad for a year and a half, 2 years now.
Yeah.
When a lot of loan officers are in here because of the refinances.
Yep.
And now those guys are gone because that's all they did, right? And only like guys like me were like kind of roughing it out, have agents and have partnerships and doing podcasts and all are still here.
There's a lot of people who became a mortgage broker or
cash in.
A loan agent, and they can't do it anymore.
Yeah.
There's a lot of real estate agents, the first few years, they don't make it through 3 years, you know, and especially in this type of market, they ain't going to make it 1 year.
Yep.
And so because there's less in the workforce, now we're talking about recession, and I really think Justin was right a few podcast episodes ago. We didn't think this was going to happen. We were talking about is there going to be a recession? And me and William were like, no, everyone's buying all this stuff, And now with the Fed saying they're going to raise the rates again, I think we are going to go into recession. They are forcing this to happen.
Yeah. I mean, I think
that's
everything...
the only way to lower it,
Yeah, everything is primed up for some type of recession.
You have to.
I just didn't think the Feds would do this to us where they're like, okay, rates are really high right now, but you know what? We're raising it again.
They wanted to crash. They want something to happen,
Yeah, I saw a video where it was like a court video with like some elite people or whatever. And they were asking him this guy, like, do you have to cut jobs in order for us to like get back to normal? And he's like, yes, we have to like continue to raise the prices and everything to get back to normal. And I'm like, okay, that to me describes the recession.
Right.
You know what I mean? Because they're doing it on purpose, and it's for the economy. Like, it hurts a lot of people. But
it's like a reset.
Yeah, it's like a reset, and they have to do it.
I feel like it's not a reset. I feel like it's a scam.
I feel like 100. Yeah, because the CEOs, they're still making millions and millions. Like, you don't need all that money.
It's a transfer of wealth. Basically.
Not even that. What I mean is that because they raise prices and they raise the rates, right? It's not about spending it. It's that value stays. So even when the economy's fixed, the prices are still that high.
They keep it
high. Like, did my movie ticket prices drop? Yeah. No. They always stay like that. You know what I mean? Did my food prices drop? No. I never seen pho go back to $8 a bowl.
Oh, I know.
Have you? No. Now they're like $17 a bowl.
Let's go back to Orange County.
Yeah, they're like $11-12.
Yeah.
Still, but you know what I'm saying? Like, I haven't seen prices go back down when they said they fixed the economy.
You're right.
They stayed.
It sounds like a scam. Like, this is the reason why I raised it, and now it's like, everything's better, but we're keeping it up.
They're going to keep it up. Yeah, that's what I'm saying.
I mean, we also haven't been in one, really.
We have. Every time you see like movie ticket prices go up, that's pretty much that time.
No, a recession.
Recession, like to 2008 times.
Yeah, 2008 times. Yeah, that was like the last time. I mean, besides COVID, but that wasn't a real like.
I think the 90s another one.
Yeah, every historically, it's like this is cyclical, so like a cycle. So
is every 20 years or
like
so?
10, 20 years.
I think we're doomed, dude.
We have to.
We are doomed.
We're gonna hit one. I don't think it'll be as crazy as the Great Recession.
I think it'll be worse.
We'll find out.
Well, I think we're gonna get something.
It's all because of crypto on this land.
Well, when you talk about Great Recession from like way back then, when I was reading about 2008 a few days ago, they called that the Great Recession.
Yeah, the Great Recession is the 2008 one. So the other one's the Great Depression.
Oh, Great Depression.
Yeah,
I see. So what are we gonna be in now?
Well, everybody's depressed right now.
So.
They can't afford nothing.
Depressed recession. I don't know.
I know. There's a lot of bad things happening in people's personal lives, and it is like a depression.
Yeah, we just came out of COVID not too long ago. It was just, and now we can't afford anything.
Yeah.
To be honest,
it's pretty expensive, man.
Everything that we went through in the last few years, I'm kind of like crossing my fingers, like hoping that something else is gonna happen right now, and not say that I want something to happen. It's more of like now I know what to expect and what I should do with my money where I should invest my money, because every time something bad happens,
the rich people get richer.
The rich people get richer, right? All the stocks crashed, and if you didn't put money in it, you don't make nothing. Yeah, like now I know, dude. When something happens, throw all your money into these places that you think you're gonna lose it all.
What do you think all these rich people collected real estate from foreclosures?
Yeah.
Once someone else's like misfortune is someone else's gain.
So this is what we need to do, guys. Every year until something bad happens to the world, we need to stack up. Yeah. Everybody stack up. Save all your money. Because when something goes down in the world, that's when you're going to spend 100K into your stocks or into a home, things like that.
Yeah. What if like the military is patrolling the streets and stuff? You think you're going to think about your money?
Well, first I'll have all of my weapons, loaded up.
Or aliens come through. You think you're gonna think about buying a house?
I will now, because I wasn't thinking about that last time. Last time I was thinking about just what you said. When I was living in California and COVID happened and they shut down everything. We haven't even gone to the market for like a few weeks, right? And they're talking about the National Guard coming to California.
Yeah.
Right? Coming on the streets, curfews, things like that. I started loading up all my guns because I wasn't trusting the military. Mm-hmm. Like, I have my sniper rifles ready.
Bro, they're just gonna throw a freaking
drone.
Yeah, drone, and then
they're talking about that. How these militias and stuff, and trying to fight the U.S. Like, bro, they don't have drones. They just have one drone, take all you guys out.
Yeah, yeah. Well, you're right. That's what I was thinking about when something was happening with the world. I was thinking about saving my life, and you're not thinking about buying stocks and all those things. But now we all should know, when you get that feeling, that's when you know to go all in with your money. Okay, when you think it's the end of the world, go all in with your money. Because what is your money going to do? Because honestly, at that time...
You all lose it, or things get better and you become rich,
Well, what I thought about at that time with my money, I was like, I need to save all my cash right now and maybe take it all out of the banks, because if we go into the end of the world, I need to use that money to bargain with neighbors to buy stuff from them. It's valuable.
Now the dollar is going to be worthless.
Yeah, you have to have like useful things like first aid. Like, I'll trade you first aid.
Yeah, like back to trade.
I'll go back to like, let me trade you my pistol for like 2 weeks of food. Type of thing. But like, yeah. So you're right. It's hard to not think about money when it's the end of the world.
Yeah.
But now I'm trying to tell everybody, man, y'all got to think about this.
Because if it's in the world, I think about it. If it's in the world, you just don't invest. And then if it's in the world, it's gone. But if it's not, and then we recover, then you invest in a good time. So
exactly, dude.
I think what's going to happen is like there's going to be this recession, and then there's going to be an adjustment where like we switch to digital dollars and stuff.
What, are you talking about cryptos or something?
Well, not crypto necessarily.
Man, I lost so much money in crypto. Fuck that.
I tried. I'm a traditional investor. I tried a little bit crypto. Yep.
You tried?
I tried. I gave it a try.
I told him to get some.
Yeah. Nope.
Nope. Like just like everybody told me to get some.
I mean, a lot of people did well.
They did. So the people that did well and
from the beginning,
to buy crypto, they did well because they cashed out in time.
Yeah.
And they didn't tell
like pyramid scheme.
Didn't tell everyone else to cash out.
Scheme. That's why I was like, oh, hey, come in, so I can make more money, and then just sell. You're stuck in there.
Nah.
If my friends who told me to buy in told me to take out, I would be good too.
Yeah.
But my friends forgot about me and didn't tell me to take out. So now all my shit is in the bankruptcy of these
block fee. Yeah.
Like man.
Screw that, Dad. That's right.
Yeah.
Now you know who's your real friends. You know what I'm saying? That's it.
Well, the crazy thing too is like our incomes are not going up.
Yeah. I know, that's ridiculous.
All these prices are going up, but then our incomes are like.
That's because the income went up right before these things happened. Like right before they asked for all this extra tips in the restaurants, right before food costs went up. Everyone was striking at McDonald's, minimum wage going up, and then when it happened, everyone was clapping. The other half people on Facebook were like, no, that means prices are going up.
They're going to screw us one way or another, dude. Yeah.
And here we are, 2-3 years later, that happened. But what hurts the most is for people like the three of us who are all self-employed, 1099, work off commissions, or working off our own hustles. We don't get raises.
Mm-hmm.
I have not seen a raise in like, even working for startups, I haven't gotten a raise in like 7-8 years. You know what I mean? So it's like,
it's hard. Even if you get a raise, when I worked for the bank for like over 15 years, like a raise for me annual is like, here, good job. Here's 15 cents.
I've never got that. I've never had a job cents. Where I got a raise. That's why
I feel like there should be like a minimum wage, right?
Yeah.
And then a median wage.
I think there should be too.
So like there's a standard for median wage, which means that's what you need to afford living. Minimum is like for like entry level people in college or high school.
Yeah.
Then you have like a median wage. That's a standard for, companies.
I think it should just be an age thing, seniority.
Really?
Like if
not even skill set.
When you hit 30, you better have a lot of skills. When you're 35, you better be like top of the company, so valuable. By 40, you should be like executive. Like you should be getting that kind of pay, bro. That's what I'm saying. And we're at the age of we know so much and we're experts in so many things that we can't be hustling for the same as everyone else is starting. Like, why do I have to convince everybody that I'm better than this guy to get his business? Like, I should just get more because I'm this old.
Yes, master.
This is the matcha whisk. It's electric. It's very convenient to use. The electric matcha whisk is a fun, easy way to make matcha in a flash when you don't have the time or the space to break out your entire set. So you can still enjoy smooth, frothy matcha in just seconds, no matter where you are. So this is the bamboo matcha whisk. It's the most traditional way to make your matcha every morning. It'll help elevate it. It's a ritual that they used to do, and this is a 100-prong traditional bamboo matcha whisk. And it's foldable, so you can take it on the go. Very easy to use. I actually love using this. It just makes the whole experience that much better. And then this ladle is the way I use to actually get the serving size for the matcha. I get the right amount by using this ladle, put it into the bowl, and I start whisking away. And just like that, by adding some water, it's ready to drink. So visit one of the locations near you so you can get some matcha, try it out. And if you guys aren't near any of the locations, go to junebishop.com. You can use our promo code WINNING to get 10% off anything on the website. I think this is a great way for you guys to really try this instead of using anything else for caffeine, such as sodas, coffees, pre-workouts. This is very clean. I do this myself and I love it. Is this a good time to get a HELOC before the rates go even higher? Because if there's people on the verge of losing jobs and maybe don't have money, but they have money in their homes, should they do a HELOC?
I always recommend, even before I got into mortgages as a private banker and investment advisor, I always recommend my clients to have a HELOC, even if they're not going to use it.
I agree with you. And I think I fucked up when I bought this house because I was going to do a HELOC. And I got scared. I was like, I put a lot of money down on this home, like ridiculous. Mm-hmm. And then to ask for another 100K HELOC, I'm like, yo, that's too much. That's too much. So I got scared. I'm like, I don't want to do it. I don't want the HELOC. And then now I'm like, I wish I had it because right now is the perfect time for me to use it.
Yeah. So it's the people don't understand HELOC. You should get it because you don't have to use it. It's $100,000. Yeah, it's $200,000, but you're not using it right away.
Can you tell me what a HELOC is?
So HELOC is a home equity line of credit. It's basically like the closest thing I can compare it to is a credit card, right? So technically, it's like a credit card where it's
or a credit line.
It's a credit line of credit for your house based on your house's collateral, and it's based on how much equity you have, right? So let's say you can take out. Say your house prices go up. That's the best time to cash in before house prices drop. Because then bam, you got $200,000 HELOCs on standby.
So the only time you guys can take money out of your home is when your equity goes up.
Yes.
Hence, equity line of credit.
Yes.
Okay.
Yeah.
And then if it goes back down, like there's no.
No, because we already gave you the HELOC.
Okay.
They're asked out.
That's why that's why I'm saying like when it goes up, just get it right away.
Yeah.
Because even if your house, we don't reassess, right? Let's say the house prices drop, like we don't go in there and then cut your price. Some banks do. But it's very rare where they go in there and cut the HELOCs out. Like I think when the recession was happening, banks were going there and cutting people's HELOC in half.
You need their money back.
Yeah, like we're not. They're scared that they might take the money and not pay it back. So they start cutting their limits, but it's really rare.
And then as far as like having it, you don't pay any interest until you start using it.
Yeah. So a HELOC, it's a 30-year loan, right? It's technically a 30-year loan for 10 years. First 10 years, you can draw as much as you want. Like you can take
as many times
you want. You can. It's like a pool of cash sitting there that you can take if you need to. But once you take it, you have to pay interest on the amount you take, right? So when you take it, the first 10 years, interest only. So that's why people take it, because their monthly payment is low.
Okay, so let's play the scenario out. Let's say I wanted $100,000 HELOC, and I take it out from you right now. What is the rate on a HELOC?
Like 10%.
Okay, and I don't have to pay that 10% until I use it.
Yes. So whatever you take out, you pay 10%. But
so let's say right now I did this HELOC loan with you, and then there's this $100K. Where is the $100K sitting right now that I'm not using?
Just in the bank or the line of credit. It's just there.
Oh, it's in that line of credit.
Yeah.
It's not like you gave me the $100K.
No, it's like a
sitting in
credit
my
card.
bank account. Okay, it's in this credit card account.
Yeah.
Right. Home credit card account.
Yeah.
And
it's just like a line of credit that sits there.
Yeah.
It's an account that sits there with $100,000 available for you to pull out.
Okay. So let's say right now I wanted to use $10,000.
Yep.
Okay. So do I pay interest on the $10,000 or on the $100,000?
On the $10,000.
Okay. And then after that $10,000, I'm like, I want to use another $50,000. So now I get interest on the $60,000
Correct.
that I took.
Yes.
And not the other $40,000.
No.
And what happens if I never use the $40,000? Where does it go?
It just stays there for 10 years. So you have 10 years to use it.
Uh-huh.
Once the 10 years up, it goes into a 20-year repayment cycle.
Oh, so I got to pay it back.
Yeah. So basically, you don't have to pay the $40,000. So basically, let's say you have $60,000. The $40,000 is there.
Uh-huh.
Once your draw period ends, that $40,000 is unused, goes back to the bank.
Oh, poof! They just take it back.
Yeah, take it back, and then the $60,000 you start paying for the last 20 years. You start paying principal and interest. You cannot pull any more money out.
That is, I wish I knew more about this when I was buying this home. I didn't know much about HELOCs yet, and now I'm just kicking myself in the butt because I've been trying to buy a rental, and in other episodes we're talking about how you can't cash flow right now as a new investor. But if you get 40-50% down, you can. So with $100K, I could have bought a condo that was $200K, 50% down, and cash flowed. Like,
because the payments, the reason why payments are high on mortgages is because it's principal and interest. But HELOCs, you're just paying interest.
Can you tell me what a monthly payment is on a HELOC that's 10% rate?
Ooh, good question. I cannot calculate it at the moment.
Like, I don't even know what it is. Is that like $500? Is that $1,000? Like $2,000?
I can tell you one that took out $250,000, and their payment was $400 a month.
Oh, that's amazing.
Yeah, their payment was $400 a month for interest.
They took out how much?
$250.
It's $400 a month.
Yeah,
that's so you could definitely cash flow.
You can do anything. You can buy yourself a restaurant. You can do anything.
Just remember though, so basically you have 10 years to pay. You're just paying interest. So basically, that $250,000 for 10 years, unless you pay additional principal, it's going to be at the 10 years done. It's still going to be $250,000 because you're just paying interest.
So this sounds like really good because it's so little payments, but obviously we're saying it feels good because we can afford that extra $400 a month.
Yeah, so you have to have a plan, right, to pay it off.
Now, if you don't have that extra $400 a month, then that's hard. So this is why people say, professionals will say, take a HELOC out on your house and go buy another home and then keep repeating so you can keep buying more homes. Utilize other people's money.
Back in the 80s and stuff.
Now, the new professionals are saying don't do that because if you don't rent out those homes that you keep buying off these HELOCs, you have to pay for the rent or the mortgage on those homes that you're not renting out, and you still got to pay for your HELOCs. So that's why people don't recommend using HELOCs for businesses because if it fails, you still got to cover both sides, right? The business and the HELOC.
You know what people are doing back in the days though?
Yeah,
they're doing, because back in the days you for HELOCs you're going to usually do it for your primary resident. That is it. Back in the days you can do it for primary, second homes, investments. So people are buying primary, took money from the primary, used that money to buy an investment, use the equity, you open another home equity line, use that home equity line, buy another investment. And
but why does the bank that's giving me the HELOC, do they know what I'm spending the money on?
Yeah, back in the days they did. Oh yeah, but no, like once we give you the HELOC,
I can do whatever I want.
Ask you, what do you need it for? It's like, it's just for emergencies.
Oh, okay. So I could take out $100K and give $50K to my drug dealer.
Yeah.
And you guys wouldn't care.
Drug dealer Justin, yeah.
Yeah. So if Justin was a drug dealer, I gave him $50K, and then I got a big batch of some drugs, and then I flipped it. Yeah. You know, I make money.
We don't ask you when you pull it out. We'll ask you when you apply. Like, it's for emergencies. So the most important thing, the reason now why I used to push it a lot is that, and especially in California, because of fires, right? So if your house burns down, insurance takes forever to give you money to recover, or where are you going to stay?
Wow, I never saw that angle before.
Where are you going to stay? You can use your credit card to stay at a hotel. You have $200,000 line of credit you can pull right away to use
and buy another home.
Fix your home, or fix your home. Pay for your hotel. You know, like, you don't have to stress.
Yeah,
it's just that emergency money, and some people use it for college funds. For emergency, like quick, like big purchases, emergency.
That's
money.
great.
Yeah.
And you said for the first 10 years you're paying interest only.
Interest only
on what you take out.
On what you take out.
That's kind of crazy.
So some people it's worth it because they use it for. Some people use it for business.
I think the best thing. Okay, obviously for business and investment opportunities is great, but the risk is high.
Yeah.
Because we're talking about opportunities. They might not meet the expectation of that goal, and that's where it's very, very risky. So the best person to use a HELOC is actually someone who's going to use it for their house.
Yes.
Someone who can afford the payments. So let's say someone has a house, they want to remodel the home, and it's going to cost them, $80K to remodel the home, and they can afford $200 to $400 a month, no matter what. That's the perfect person to use it. It's like another car payment for them. They can afford another car payment. If I want to put a pool in my backyard, I can do that for $200 to $400 a month, and I'm fine with that.
Yeah, for like remodels or for emergencies. I always recommend having there because you never know.
If you're that first-time business owner and you're trying to buy a restaurant and your restaurant never has customers, you got to pay for this HELOC and the rent over there. Your rent's going to be like $3,000. Then you got this HELOC $400, $3,400. Then you haven't been paying your employees, all the equipment you bought, and oh my God.
That's why I think we should do an episode about business. Because that's the best way to do is do business, do LLC and do a business loan. Because that's the safest way to do it. Because business loans, they'll lend you. I should do business banking too. They'll lend you business to buy a startup.
Well, how does that work? Because when you buy most of the business loans, they give you the money once you have a business. But how do you say, hey, I want to start a business. Can I have money?
Yeah,
SBA.
There's some SBA. There's some programs that help, and there's some banks that if you say you're buying another business, we just got to see how that business is doing, and we'll use that income and like, okay, it's successful, and we'll lend you the money to buy the business.
Like, I want to open a restaurant in Chinatown, Vegas right now. Like, I have this really great idea that I'm not going to say on this podcast, but and it's not here in America yet.
I mean, us three can help you, but we got to buy in. That's
so how do I get someone to say yes?
Yeah, we'll look into it. I'll look into it.
And what does the interest look like on that?
Good question. I don't know that part, but I will find out for you.
For something that's never started before, that's hella risky for the lender.
Yeah. So
I'm like, it's got to be like 20%.
But
interest.
Sometimes you get the right lender. Like the stories, like you see those stories all the time. Like back in the day, Pinkberry, I think American Express took a chance on them. Well, you never know.
Yeah, maybe we tell them we have a podcast, they'll be a little more lenient.
Yeah, we just got to paint a good story and we're like.
So what's not a good scenario to use a HELOC?
Great question.
To buy cars.
Do people do that?
Go shopping.
They just buy like a Lamborghini really quick. And
some people go crazy. Go shopping.
So it's buying something that's going to make you pay double.
Right? You don't need it.
So it's like the car, you got to pay the car payment and the HELOC payment.
Yeah.
Same thing for the house.
Well, a car, you pay off cash.
Yeah, you pay it off.
But like, yeah, well, if you're just wasting it, yeah.
You pay it off cash and then you pay the $400.
But you're losing appreciation. You're not making money.
With Lamborghinis and Ferraris.
Yeah, you lose price, dude. Maybe not Ferraris, Lamborghinis.
Well, when there's your limited edition that are like $300K, those will go up in value.
Yeah, the regular Lamborghinis.
So
buy a Bugatti.
So what if I bought like 10 Rolexes?
Yeah, that's a good investment.
I mean, it's not that much. They only go up like 3K. You know?
No, some of them like double.
Well, yeah, okay. If you get the
20K,
ones that are like,
you gotta buy a Patek or whatever.
You gotta buy like a
that's
50K watch
value.
minimum. If you get a 50K watch minimum, then they will go up in value.
I think like the Daytonas or whatever, they were used to be like 15. Now they're like 20, 30.
The ones that take like a year for you to get, those will be worth a lot.
Those are good.
Yeah.
I always wonder.
The regular ones is still so. I think mine's still from 2012 and it's still holding the price. I can still sell it.
They'll go up like Those will go up like 3K.
Yeah.
I always wonder if that's what like some rich people are doing, like to look like they're balling out and stuff, but they're just hella in debt.
Yes. There's a lot.
They're like doing all these like HELOCs or whatever.
That's why like those people that walk around with Gucci, LV, like some of them drive Mercedes, like some of them live in apartments. Like you can't, like the rich people, like really, like I'm talking about. Remember I talked about rich and wealthy.
Yeah,
the wealthy people, like
they
very low key.
Yeah,
like, my wealthiest client when I was in my private banking, dude, he walked in with like sandals and like just regular like house pants and a t-shirt. That guy, you know why? That guy's worth $35 million.
It's because he just flew on his private jet from Hawaii to here, and he's still wearing his Hawaii clothes.
No, it's yeah. And but then his wife shops at like Ross.
That's
like,
pretty
but
gangster.
They bought a $3.5 million house cash. Like they're balling, but you can't tell. Like you can't tell. And then I have people walking in like Gucci, like you know, and then you pull up their accounts like, oh my god, you're $400,000 in debt, bro. Like. Yeah. In like credit card debt, you know.
I mean, you look at who dresses clean and doesn't show off. Yep. That's like Bill Gates. Yeah. Right. Mark Zuckerberg.
You see all of them, they're just simple.
Elon Musk.
But like their shirts are like.
Yeah, like, they're like $200 shirts with no labels.
No
on
labels.
It.
Like only the other wealthy people.
I don't even know where you find that shit, dude.
Yeah, you have to be like super wealthy.
All I see are Hanes for like $5 or $10.
Yeah.
Dude, you know who's been coming up?
Who?
Abercrombie.
What? What do you mean?
Yeah,
I thought they did already.
Abercrombie right here.
What's coming up about it?
Well, yeah, that's things like, not dead already.
They're doing more like baggy stuff.
Oh, so they're like
doing the cargo.
Oh yeah,
they're getting cultured.
Like, yeah, and I'm like, dang, they're actually putting out some nice clothes.
So
now.
It's more like skater instead of beach.
Yes.
Yeah, some
beach
stuff.
vibes. Yeah.
Or like they, it's kind of like Zara too.
Oh, so they don't have like 6-pack guys standing in front anymore. Like,
yeah. I mean, I don't think they do.
Because you know why? Most I don't see any more like white models guys walking around everywhere and like
that's not the thing anymore.
Done. Yeah, they're all hipsters now.
Yeah, now they all look like Kid Leroy, right? With like bangs and with a skateboard and hats that you're wearing.
Yeah, you're fashionable.
I'm trying to be. Nah, I'm just kidding. But yeah, they're coming up. Where were we?
I don't know. I think this was a great episode. We learned a lot about HELOCs, when to use it, why you should use it, when you shouldn't.
Yeah.
Guys, if you want to get a HELOC, there are people who I would say, we have some clients who they're on a loan or on a mortgage with their parents because they help their parents get the home, and they also don't have down payments because obviously inflation is crazy. So they're taking out HELOCs for down payments to buy a new home. Yeah. You know, and that's one thing you guys can do too. So a lot of people are doing that, and whatever. Everyone's situation is different.
Yep.
If you need help, we'll help you. Reach out to us. And guys, let us know what you thought about this in the comment section. Okay, please let us know what you want to talk about and what you want to learn about. We would love this information. So see you guys next time on the Next Win podcast. All right, guys. So head over to thejumbishop.com and you can get 10% off anything on the website by using our promo code WINNING.